Hello, everybody, and welcome to the Middle Class Investor this week. This is Seth Martin, and we had another down week in the market, as you can plainly see here by the red candle. In fact, let me zoom in a little bit better. The market was kind of due for a pullback. We'd run into kind of the teeth of this resistance here. And we were talking about, it was likely to get a pullback. In fact, we were talking about it for a couple weeks. So it was a little bit overdue. And we finally did get that pullback. So you can see here, market's pulling back nicely, down here in this channel. And it's possible that it not pull back very deeply, but it really depends. I mean, this is just a jumbled mess. If it pulls back, where it should, it's really going to pull back somewhere in between here. I've got this box is not really drawn correctly. It's really more like this right in here, where it could pull back as far as the area around this high. Let me zoom in again. Sorry about the jumping around, but it could pull back into this area right here, or you can see this pivot low right here, somewhere in that zone. So, in fact, when I'm done, I'll move this box up just a hair. It's a little bit deep, but and that's likely to happen, likely to begin happening next week. It's just once you get a rollover like this, it's kind of hard for the market to roll over. But then once it does, you start seeing big candles like these, and so we're likely to probably get some of that next week. Let me move this box just a hair, like right there, and that ought to do it. Now, one of the things I want to show you, let me go to a daily chart, and oddly enough, I don't even have to draw the line because the line's already there. But we've got kind of a potential head and shoulders pattern that has developed in this market, and you can see it. It runs right across here, right where I've got this other line. And technically we broke it today. I tell you what, yeah, we're on the Dow. That line's kind of flat there for whatever reason. Maybe if I zoom way in on it, yeah, there we go. It's a little less flat. Problem is then I get too much zoom. Yeah. So there's no perfect way to do it using this zoom tool. But you can see here's the left shoulder, here's the head, and here's the right shoulder, and there's the break. So I have another tool. The way this works is, the way the head and shoulders pattern works is you measure the top of the pattern down to the neckline. So that would be this distance right here, from here to here. And then you duplicate it at the breakout, so from here to here. And that's why I have the box drawn where I have it. So, once this breaks out over here, this height right here, it tends to move to that height, which coincides with this little pivot low over here around this area. So that's what I would expect to happen over the next, several weeks. Now, it could pull down a little bit Monday, a little bit further, and then retest this area and then drop. That happens a lot. In fact, if you're someone who's trying to short the market, you're kind of hoping that happens. That way you get a little bit better price entry point. Let me show you kind of how you if you're looking to trade this, this is kind of how you would set this up. This line right here says open. Now this is the Dow Industrials. So, we're talking about an entry at 17. What is that? 17. Maybe have the market rise a little bit to 17,565, and then your target would be down here at 16,805 roughly. And you can see right here, this 3.59, this is the reward to risk ratio, and then your stop would be up above here. So this kind of gives you an idea visually of the reward to risk. Notice the reward, this green area, is much larger than the red area. And this is how one sets trades up. Now, obviously, if you're 401k, you're not going to be looking at that kind of a trade. But I wanted to show that because this tool had come to my attention recently, and it's a pretty good little tool. It's called tradingview.com. It's a good little charting. You've got all the stuff that you would need for charting. And it's all in the cloud. It's real fast. You can change, from a day to, a week or a month or 45 minutes or whatever you want. You can set up candlesticks, Renko charts. Some of this stuff's not even, you guys probably don't even know what it is. Point and figure. There's all kinds of things you can put on indicators. Like if you want a moving average, you can put on a simple moving average. Kind of like what I have over here on Thinkorswim. On this right here, you see these lines here that are brightening up when I touch them. Those are moving averages that I put on there. So you can do things like that. Anyway, there's let me get rid of that for a second. There's a high probability that that this comes down here, next week. Now, will that be the end of the low? Well, a good way to excuse me. Good way to test that is with Fibonacci. We come down here to the previous low, up to the high, and yeah, that would be a 50% retracement, which is pretty common. I mean, usually you get either a 50 or a 61.8% retracement, and you can see both of those numbers are right there in our zone. So, 16,809 on the Dow, and I think you're around 1960 or 1965 or so on the S&P. So look for next week to be a little soft, and maybe the next several weeks as the market pulls back from its current location. In fact, what could happen, I mean, I've seen this happen many, many, many times. Let me zoom in. I'll pull the Fibonacci off. I just want to show you here. It's not uncommon, actually, to get a pullback into this area or maybe just shy of this area. In fact, if it doesn't quite make it down into this area right here, around this wick between here and here, a lot of times what you'll get is a bounce like so, and then you'll get even like a deeper pullback into this area over here. So if we don't quite get into this blue box and you're still waiting for a place to go long, you could wait a little longer and have it pull back even deeper, and this would be an excellent area to go long the market, be long your 401k, things like that. All right, I hope that's clear. Let's look at some of the other markets before we switch over to. Let's look at the 13-week Treasury. This is, if you recall, this is it's the IRX. This is the market that I use to kind of predict, if you will, whether or not the Fed's going to raise rates. And as you can see, it broke out, it retested, pulled forward, and then came back to the line and then started to move out again. So um, if rates move up into this area around zero point 0.4, the Fed will be raising rates. I, you could argue whether or not the Fed should raise rates and does it make sense, but the Fed is more interested, believe it or not, in pretending that they are in control of this than they are of kind of being forthright with the American public. What I mean, let me be clear what I'm saying. So what I'm saying is, and I've said this before, the Fed doesn't set rates, it follows rates. And so as these rates begin to move out, even though the economy will not be doing well and, credit won't be readily available and the Fed's going to come under a lot of criticism, if you see rates, if you see this IRX pull out above these highs and move out, the Fed will be raising rates no matter what the criticism, no matter what the chatter is, no matter how many pundits come on TV and criticize them and tell them that they're screwing up and what are they thinking. It doesn't matter. They're going to continue to do it. Now, the longer term rates, the 10-year Treasury, broke a key level here. Really, it broke it last week, but I was giving it a little bit more room to. We've talked about how these big white or black candles end up being support or resistance, and we broke now cleanly through that. And I would expect I don't like the way that looks. Let me zoom out a little further. I would expect the 10-year Treasury now to probably pull back below this low here, and maybe even below this low. So we could see the 10-year Treasury pull back into this box that I've drawn here, way down here around 1.5%. Still believe that the U.S. Treasury will stay above this low from way back here, but it's highly likely now that this is all part of some correction here, and that the U.S. Treasury is going to pull back into this box, an area around this box, before we see it move out. Now, short-term rates could move out, quicker than the 10-year or the 30-year. You can see the 30-year looks very similar, although the low in the 30-year came in 2015, right in here, and on the 10-year, you can see the low was back here in 2012. So what's interesting here is the 2010. That's why this looked like such an important low, but then of course we came back and made a lower low. So maybe the 30-year is probably the more accurate chart to be looking at. I'm not sure, but certainly I'm gonna say that the 30-year Treasury is gonna at least pull back into this 2.4, 2.3 area before it moves out. I think this is this low is an important low, but clearly the market looks like it wants to pull back into this box or thereabouts. So we'll just wait and see what happens. There's not much to do but wait. We're still, from a reward to risk standpoint, yields are much more likely to be higher in the future than they are right now. The closer we get to this number, the closer you are to like 50-year lows in yield. So I would not be buying bond funds. If you're buying bonds, you want to keep them very, very short term. Let's see, what else do we want to look at in this list? Germany. Germany's pulled here to support and has moved out. It could still be in a downtrend. It looks like maybe it is. It hasn't quite, I like to use a channel sometimes on these. If you draw kind of draw the downtrend line as an area as opposed to a hard line, but it looks like it wants to continue its downtrend. So we'll operate kind of under that thesis for right now. Same thing with Japan. We'll look at the Euro US dollar and the Japanese yen US dollar. Those are some important currencies, and there's some important things happening in those currencies. I want to make sure we point that out. Let's look at crude oil. Crude oil, it's interesting. It's really slowed down near this line that we had drawn here. And if you recall, I said, well, you know, I was expecting it to get up here into this box, but maybe it doesn't quite make it there. And I drew this line there through, you know, all this congestion area right in here. So the main reason I drew this line, let me explain. If the market, let me back up here. Let's look at this whole move right here. So let's see, can I do that without zooming in like that? Yeah, let's do it like this. So you've got, I want you to just kind of bear with me here on the way this looks. So notice, whoops, I'm gonna have to draw that a little bit more like this, a little bit more of an angle. Okay, so notice we have this 1, 2, 3, 4, 5. So if you look at Elliott Wave, we should have gone back to, you know, this area right in here. In fact, some time ago I said that that was the target area for a bounce. But notice what happened. The market went up and it fell short. It didn't even come anywhere close to getting to the previous wave 4. So what does that generally mean? That generally means that the trend is extending. So what happens is you have another 1, 2, 3. This would probably be 4 down here and 5. So I'll have to zoom in to show you that. And then this is probably some larger degree wave 2 right here. So, or it could be extending again. So that's why I drew that line here, because if it's extending it again, if it's going to extend again, then it's probably going to start rolling over here somewhere and then go down and make a lower low. If it's actually going to bounce, then it could come up into this area here, pull back a little bit, and then bounce again, and maybe even make it up into the 70 area. But to me, it looks like oil still got lower to go, especially when you look at the bigger picture. And the bigger picture is, I mean, it could stop here. There's no, I mean, if we did the Fibonacci, let's do a Fibonacci here and just see what we are at the retracement. I mean, I think we're already at 62%, so it could very well stop here. That's roughly it. So yeah, we've got, I mean, we've done a 78% retracement. So, you know, oil could be done. It could very well be done. And you know, now we're going to make a move higher. But you still, even if you're going to trade oil, let me talk to you about the circumstances under which you trade oil. Let me get rid of this Fibonacci. Okay. Oil, in order to really feel good about trading it or to invest in it longer term, what you want to see is for it to stop, pull back like so, to a higher low and start to turn up like this. So you want to get, there's a low, there's the previous low, here's a higher low, and then you want to see oil turn up from there. So what we want to do is we want to do a Fibonacci from here to wherever it stops, and then look for at least a 50% retracement, and maybe as much as a 61.8 type 61.8% retracement before, and then wait for it to turn. So maybe a week or two on a weekly basis, wait for a couple of up bars, and then start looking for oil stocks. looking for energy to invest in. That's the safest way, because otherwise you're just trying to catch the proverbial falling knife, and that's always difficult. Let's see. What else can we look at? We can look at gold. Gold and silver, recently have been very strong. You can see we almost got up into that area where we drew that box, and didn't quite make it. And it could just be I drew the box in the wrong place. These boxes are a zone. They're not really, hardcore lines in the sand. But from this point, it looks like gold has started a pullback, and we should see gold, pull back first to there, and then maybe somewhere like right in around this 1180 area, and then really take out from there. So big picture on gold is it's in a downtrend. So it's in a really long term, it's in an uptrend. So you've got this huge move up, and now we're in this downtrend. So we've got kind of the first move down, then you got a little counter trend, and then you got another move down. So again, if we use Fibonacci, hopefully you guys are familiar with Fibonacci. I haven't. It seems like this is the most I've ever talked about it. But if I go from low to high, the 61.8% retracement is around here, around 895. And then the 78.6 is down here around 650 or so. So those are two areas that and technically oil could still be in an uptrend even if it pulled all the way back, down here somewhere to 350. So, but I would say given this deep wave A pullback, that we're probably gonna have a little B, up around here to 1500 or so, and then have a C that pulls back into this congestion area right around here, around 895, 900. Be a really good place to buy gold physically long term. Silver's kind of the same thing. The silver chart was a little bit of ahead of the gold chart, but silver, has rallied here recently. We've got this area around 2580. So maybe look for silver to pull up into that 2580 over the next year and a half or so, and then silver to pull back here to below $10 before moving higher in a very, very, if you can buy silver down here at around $8-10, you're doing really well, because silver is on its way to probably $200, $150, $200. So anyway. What else do we need to look at? We've already looked at our little risk reward. If we look at crude oil on a weekly basis, you can see if I put the decision point on the swing that's above where we are right now, then that brings oil to about $65. So it's still very much in this downtrend. It really hasn't broken out high enough to be not in the downtrend. In fact, it looks like, the strength indicator looks like it's going to start pulling it lower. Could pull it down here to 35 before it bounces higher. So right now, is not a place where you want to get into energy. It's probably where you want to step to the sidelines, let energy pull back here to the mid 30s, $35, $36, and then look for bullish positions on energy stocks. Let's see, what else do we have here? We got this is the UK market. It looks like it didn't quite get high enough there, did it? If you take a DP off of this swing here, it didn't quite go high enough, but it could pull back here and then rally, up into this DP. This could all just be a big wave too, In fact, let's see where the wave 2 would rally to. Yeah, it could be into this area here, maybe even a little higher, like up here around the decision point, which is likely. So we could get a pullback back to the trend line and then bounce. But for the time being, definitely the UK is in a downtrend. So would stay away from longs on that. Let's see, what else do we have? That is really about it. There's really only two sectors that are performing well right now, and that's utilities and consumer discretionary. So that doesn't bode well for the market. I mean, if you even financials, a lot of people say that it's really hard for the broad market to get going without financials. And you can see here that this is the XLF, which is the ETF for financials. Whoops. And you can see here that, kind of in this little downtrend. So, maybe we see financials pull back here a little lower and then bounce. And then, basically the market is still very high in this range that we've been in. I mean, we're still up in the very top of this range. If you look at this in terms of congestion zone, we've drawn this before. Whoops, that's not what I wanted to do. I want to do this. You can see we're very much in this congestion area, so that tends to grind the trend down to a halt and then reverse it. And I would look for, see this dotted line here that I have on the well, let me zoom out a little bit. See this kind of this convergence. Well, it's hard to even see here. I need to zoom out a little bit more. You can see that where these two lines converge, this line here, and then the bottom of this channel line is right around here at around what is that? 1916. I mean, we could pull down as low as that because the channel and that line converge right there was at 1930, let's say. So we might pull down here to 1970, 1980, bounce, and then come down again into this area, but the channel is likely to hold. This channel, the reason it's drawn that way, let me zoom out a little further and I'll show you. Let's look at a 10-year. See this first move here? You had this first move and then you had this deep pullback. If that's a wave 2 pullback and this is a wave 4, you typically connect those two with the top of the primary, strength wave, and then that gives you a channel for, support in the uptrend direction. So what we could see, for example, let's just speculate a little bit. You could see this pull down to this area, say right in here. Maybe it pulls down like this, where you get a little bounce here, and then it pulls down like so, okay? And then you could get a really strong move, literally all the way up into this area. I mean, it's possible. A pullback, near the midline, and then a last push to there. And if that's the case, there's going to be some money to make, but we need to wait for this to pull back a little bit, maybe to this channel line, and then let's go in with our 401k there, and or once it turns a little bit and starts to go up, go in with our 401k money there and let it ride to the top of this channel and so on and so forth. So, all right, everybody, that is it for this week's Middle Class Investor. I hope that helps you see a little bit about what you need to do or not do in the market. We've got this, I guess we're still in this big bull market until, we didn't talk about that, but unless this low right here these lows right in here are taken out, this bull market is still intact. Now, it looked like it was over right in here. I mean, it broke this blue line, this channel, this this blue line right here. It broke this line way back in, I don't know, end of the year or first of this year, and it looked like it was all going to be over then. But then, I don't know, it pulled right back to this channel. You know, to if you make a channel off this low, it pulled right back to this channel, and this was a pretty strong move here. So, I mean, we could still be in a bull market, and we could be looking to move up into this area above 2,500. And if that's the case, you know, from the mid 1900s or say 1930 on the S&P to 2,500, that's a good run, and you definitely want to capture that in your 401k. All right, everybody, that is it for this week. Come in next week and let's look at the market again, see if we're making our way. You know, I want to try to help you pick the place where, you know, we got a good low risk entry into the market, but for your 401k. But we're definitely going to, over the next several weeks, experience a little softness in the market. So be prepared for that. Okay. All right, everybody. Thanks a lot and take care. We'll see you next time. Bye-bye.